We live in a microwave society, right? Like we expect things quickly, more today than ever before. You work with a lot of folks in the demographic of that, that we can relate to, 35 to 55-year-olds. You're covering that 20-year span of folks who, generally we expect things pretty quickly. How do you teach, coach, get acceptance from those individuals who expect quick things that don't happen quickly?
I think you have to set expectations. I do think the harsh reality of it is that those people may never be clients. They might never raise their hand to work with us in the first place because those are the people who are trying to find the super speculative investment, whether it's penny stocks or some sort of cryptocurrency that may not be as mainstream, or the rare basketball box break or something like that, right? Those are the people who are trying to turn a dollar into a million. So I think there is some sort of selective process that weed themselves out from ever raising their hand and say, hey, I'd like to meet with a financial planner. So I don't have to experience a whole lot of that. The one thing along those lines that I think the most education occurs around this idea that stocks make 7 to 10% per year. This comes up a lot. If I have $100,000 today, I would expect to have $110,000 next year, and the year following I would have 121,000. And they think that there is some sort of linear return to building wealth, which is certainly not the case. I think in the past 90 years or so, there's only been about 4 times where the stock market has returned between +7 and +10% per year. So the vast majority of the time, the stock market is either up a lot, more than 10%, or about 30%, 25 to 30% of the time, the stock market is negative. So we always have to drill those things into the mind. And I think it's imperative that you have that conversation up front with people that the stock market in any given year is going to drop 15%. Doesn't mean we lose 15%, but from top to bottom, it's going to have about a 15% correction every year. And every 5 years, there's going to be a 25% or greater correction. Because as long as we have a plan to build wealth slowly, where we're making contributions every 2 weeks, every month, whatever the case might be, we're going to acquire more shares in a down market than we would ever have the potential to if the market continued to increase by 10% per year. But you have to have that conversation on the front end before they become a client.